core consumer price inflation is expected to come in a bit cooler than the month prior. Now, this will come ahead of the Fed decision and the subsequent presser from Fed Chair Jay Powell. So how will the totality of the data impact Powell's commentary and the Fed's path forward? We want to bring in Jason Furman. He is Harvard's Kennedy School of Government professor and former Council of Economic Advisors, a chairman under President Obama. It's great to see you again. So let's start with the significance of these two events happening on the same day. There has been some hiccups in the Fed's fight here to tame inflation. What are you expecting to see, and ultimately how that's going to shape the Fed's next move?
Yeah, I mean, obviously they won't be able to respond to the data, and they're locked for no move this month. I don't think they're going to consider a move till September. I doubt they're going to cut rates until December. Even if it's a decent CPI print, the problem is, the good months it's at 2%. The bad months, it's way above 2%. That means it's averaging out to a decent amount above 2.
Jason, you mentioned your call of December. To what extent is the November election part of that decision for you?
I think it raises the bar just a little bit. It shouldn't, but they don't want to appear political, and paradoxically, not appearing political means they'll need a little bit of a higher bar. But I think the bigger issue is back in December, we were looking at 6-month annualized core PCE inflation of 1.9. 2 months later, it turned to 3. They're going to need a lot of data to reassure themselves that it's real. So even if we're looking at 6 months in a row of 2% inflation, that may not even be enough for them when they've just seen this worm turn so many times before.
Jason, talk to us and explain to the viewers just why it has been so difficult for the Fed to tame inflation and why this last mile continues to be a bumpy one at best.
Yeah, look, we've gotten further than I would have thought without anything like a recession. But some of this inflation probably is embedded in expectations. You see high wage growth leads to high price growth. High price growth leads to high wage growth. And that's a staggered process. So in the best case, it's going to take a while for it to asymptote itself back down towards 2. And in the worst case, it would require some, elevated unemployment if that's what the Fed decides it needs to do to get there.
You know that the rapidly growing population is playing into some of the headlines that we are looking at when it comes to the labor market. Can you explain the degree to which that is playing into this picture that we continue to have this robust growth in our economy, and how much that's true given that population growth contribution?
Yeah, I mean, over the last year, we've seen 250,000 jobs a month, and yet the unemployment rate has drifted up. That's extraordinary. A bit of that is some increased labor force participation, but a lot of it is that the immigration inflows are just much larger than we thought. Now, it looks like those immigration inflows are starting to slow. So where it looks like we're going to go back to a world where break-even job growth is, more like 100 to 150,000 than possibly the 300,000 break-even we've had over the last year. So big question about how much immigration supports things going forward, but in the rearview mirror, it's been a big part of the growth story, a big part of the job story.
Well, talk about the impact of President Biden's executive order on immigration recently, which would limit asylum at the border, to put it very simply. What read-through could that have on the broader jobs data that we are seeing? And could that lead to a potential softness that folks would not be comfortable with?
Yeah. So his effort is part of the reason why I think immigration inflows are going to be slower going forward than they have been in the past. Now, this matters more for the number of jobs than it does for GDP, because a lot of the workers we're talking about here sort of produce less output per hour and add proportionately less to GDP. But in general, one of the big strengths of the U.S. economy, one of the reasons we're doing so much better than so many other advanced economies is immigration. And at all levels, it's something we want to figure out how to encourage, but of course, encourage it in a lawful and legal way.
Jason, how big of a reason, just in terms of the influx that we have seen of in immigration, the high numbers, is that a big reason as to why the U.S. economy has been able to avoid a recession up until this point?
I think it's part of the reason, but we've been growing at about 2.75% over the last year, and immigration's a part of that. Demand is a big part of that too. We have a very large budget deficit. We have an unusually large budget deficit for an economy that's in as good shape as it is right now, and that's definitely playing a pretty big role in our economic strength as well. What that means for the medium and long term, though, is more dicey.
So, Jason, you note that we have the perils of recession on one side and the risk of prolonged high inflation on the other. Is it a zero-sum game here? Do we have to pick one or the other?
We don't get the choice. We get what we get, and we don't get upset. So yes, I'm rooting for a soft landing. I think there's a decent chance that we're going to be able to complete that soft landing. But there are these two perils on the two sides. I think at the current moment, the inflation peril is still the greater one because we actually do have inflation right now, and the best forecast of the future is what we've gone through. But recession's an issue as well. So that's what the Fed's going to be navigating over the remainder of this year and forward.